Welcome to Value Investing University. My name is Mariusz Konieczny, and in this video I will be talking to you about financial ratios. In order to get the most out of this video, I would suggest that you first watch my other videos on accounting, which include Accounting 101, understanding the balance sheet, understanding the income statement, and understanding the cash flow statement. In order to understand the material covered in this video, you need to be familiar with various financial statements and accounts that are included in them. You see, knowing how to read financial statements is very important. But the problem with just financial statements is that they report raw data. For example, the income statement tells you how much revenue the company generated. But so what? This number alone doesn't really mean anything, because what we need is some kind of comparison to something else. The company generated X amount of revenues in relation to what? Well, it could be in relation to costs, in relation to assets, in relation to shareholders' equity, or maybe even in relation to another competitor in the same industry. Now, after comparing a particular number to another number, then we can get an idea of what they might mean and whether there's any pattern from one reporting period to another. With that being said, performing comparative analyses is not just in domain of businesses or financial analysis. You constantly do it in real life. For example, if you ran a marathon and you took 6th place, well, would this be good or bad? Well, it depends. If there were only 6 people in the race, then maybe it is not such a good thing. But if there were thousands of participants and then you took 6, then probably you did fantastic. But even then, if those participants were children and you're a professional runner, then taking 6th place is probably not something that you want to brag about to your friends. So you get the point. Something is only good or bad in relation to something else. And creating financial ratios is all about taking an individual raw data contained in one of the financial statements and comparing it to another piece of raw data from either the same financial statement or from a different financial statement. And what we're trying to do by doing this is we hope to learn about the strengths and weaknesses of companies, and maybe we could even uncover certain red flags that need to be investigated further to learn more about the particular companies. I categorized financial ratios into 4 categories: liquidity ratios, efficiency ratios, profitability ratios, and solvency ratios. So without any further delay, let's go ahead and get started. The managers of publicly traded companies love to talk about the future potential of their enterprises. And this is fine because, you do want to know what kind of goals they have. However, there may not be any future if the company does not have enough money to pay its current bills. In other words, the company may go bankrupt before its bright future arrives. And to determine whether the company is in the position to pay its current bills, you can calculate what is called liquidity ratios. And here they are. The formula for the current ratio is current assets divided by current liabilities. Let me show you an example before I describe it in more detail what the current ratio means. This is the balance sheet for Flow International Corporation, which manufactures water jet cutters for
various different industries. To calculate the current ratio, we take current assets, which in this case are 115.5 million, and divide them by current liabilities, which in this case is 59.1 million. So let's give it a try. 115.5 divided by 59.1, and we get a current ratio of 1.95, so let's call it 2. What this tells you is that Flow International Corporation has enough in current assets, which are cash, accounts receivable, and inventory, to pay for its short-term bills. Generally, it is good when the current ratio is more than 1, which means that current assets are bigger than current liabilities, and this is certainly true in case of Flow International Corporation. If the ratio is less than 1, then you need to pay attention. For example, let's assume that Flow International Corporation had lots of debt, and a big percentage of this debt was coming due within the next 12 months. You see, this amount would show up right here as the current portion of long-term obligations. If this amount was, let's say, 200 million, well, then there would not be enough money in current assets to pay it back. Then you would have to figure out what the company is planning to do about it. If they don't have a plan, then this is definitely not a good sign. Because how are they going to survive if the money is coming due and they don't have enough to pay it back? They might be forced into bankruptcy. So while a current ratio of less than 1 should make you pay attention, you do need to understand that it is not always bad. It really depends on the industry. And this is why it's always good to compare the current ratio of a particular company to some of its competitors and not the companies in a different industry. Let me give you an example of a company that has a current ratio of less than 1 while the business is perfectly fine. The name of the company is Walmart. You see, this is the balance sheet of Walmart, and as you can see, the current assets are 55 billion, but current liabilities are 62.3 billion. If you calculate the current ratio, you get 0.88, which is less than 1. And if you did not understand why it is like this, then you might unnecessarily panic. The reason why Walmart can have a current ratio of less than 1 is because of the fact that its suppliers are financing its inventory. You see, the biggest portion of current liabilities for Walmart is in accounts payable, which is what the company owes to suppliers of various products. Walmart is able to put the products on the shelves and sell them to the end customers before it even has to pay its suppliers. And this is a very enviable situation that they're in. If you and I wanted to start a store like Walmart, we would not have enough bargaining power to have the suppliers extend such wonderful financing terms. But with Walmart, they do so because Walmart is so powerful. The formula for a quick ratio is current assets with no inventory divided by current liabilities. This formula is very similar to the current ratio formula, which we just discussed, but with one major difference. You see, when we were calculating the current ratio, we took current assets and we divided them by current liabilities. In other words, we assumed that accounts receivable and inventory were going to be converted into cash before the bills under current liabilities came due. What if inventory is not sellable because it got damaged, or maybe it became obsolete, or maybe it will take too long to sell? Well, in this case, we take out the inventory from current assets, and we use that number to calculate a quick ratio. And here's what I mean. So let me take out the calculator. We take the previously entered number, 115.5, which is total current liabilities, and we subtract from this number the amount for inventory, and in this case it is 40 million. And when we do this, we are left with 75.5 million. And now the question is this enough to pay all the current liabilities? Well, let's see. We take 75.5 and divide it by total liabilities, which in this case are 59.1 million, and we get 1.28. So yes, current assets without inventory would definitely be enough to pay this company's short-term bills. So this is how you calculate a quick ratio. Doomsday ratio takes the conservativeness even further. The formula is cash divided by current liabilities. In other words, we are painting the worst case scenario. If the business were to stop its operations, is the cash on the balance sheet enough to pay for the company's short-term liabilities? In this example, we take cash, which is 13 million. So we type in 13 million, and we divide it by current liabilities, which is 59.1 million. And we get 0.22. And this is understandable because the amount of cash is 13 million and it is less than 59.1 of current liabilities. So what a doomsday ratio of 0.22 means is that if Flow International Corporation were to cease its operations right now, it would not have enough cash in the bank to pay for its short-term bills. But because the company is profitable, there's really nothing to worry about when this ratio is less than 1, because in the normal course of business, you should expect both inventory and accounts receivable to be converted into cash, thus increasing the company's liquidity position. Actually, if the doomsday ratio is more than 1, then I would start asking questions. Why are you holding so much cash? Do you expect the business to slow down? Are you planning on making any acquisitions? If not, then why don't you just pay out some of this cash as a dividend or maybe buy back your shares?
There are all kinds of businesses out there, and some of them operate more efficiently than others. For example, one business may require fewer expenses to generate the same $1 in profits or revenues. One business might be able to turn its inventory much faster than another business, thus allowing the company to earn greater profits in a particular year or a quarter. The goal of the efficiency ratios is to measure the management's effectiveness in using the company's resources to generate a certain output.
The formula for the total expense ratio is total expenses without the cost of goods sold divided by total sales. And here's what I mean by this. We take the total operating expenses plus any other expenses such as interest expense and other expenses, but we do not include cost of sales. So here's what I mean. Let me take out the calculator. We know that total operating expenses are 84.7 million. So let me just type it in, 84,699. I add to it the interest expense. In this case, it's a negative number, but negative number for other expenses means it's an expense, and positive number we subtract from expenses. So we add 1.1 million for interest, and then we add 954,000 $100,000 for other expenses, and then we subtract the 62. So we get total expenses without cost of goods sold of 86.7 million. And we take this number and we divided it by total sales, which in this case it is 253.8 million. So 253,768, and we get 0.34 or 34%, which means that the company had to spend 34 cents in operational expenses in order to generate $1 in sales. Is this good or bad? Well, it depends. The best thing is to compare it to other years. So let's say, remember the number 34%, and let's do the same calculation for 2001. So we take again total operating expenses, so it's 79,574. We add interest expense 1,776, and other expenses now become other income, so we subtract 686, and then we again subtract 106 for interest income, and we get total expenses of 80.5 million. And then we take this number and we divide it by total sales, which in this case are 216,524, and we get 0.37 or 37%. So if we compare 2001 to 2012, we get an improvement, because in 2011 the company had to spend 37 cents in operational expenses in order to generate $1 in sales, and in 2012 it only had to spend 34 cents in operational expenses to generate $1 in sales. So in this example, there's an improvement from 2011 to 2012. And in general, the lower the ratio, the better, because the company is able to generate a certain output with fewer expenses. The calculation of the expense to gross profit ratio is similar to the ratio that we just discussed, but instead of comparing operational expenses to revenues, we compare them to gross profit, which is sales after the cost of goods sold are subtracted. And here's what I mean. Let me give you an example of how you would do this calculation. So we would do the same thing that we did before. We would first take all of the operating expenses together. So in this case it's 84,699, and again we add the interest, we add other expenses, and then we subtract 62. So this is all of the operational expenses, but now we take this number and instead of dividing it by total sales, we divide it by a gross profit, or in this case it's called gross margin. So we take it and we divided it by 99,368, and we get an expense to gross profit ratio of 0.87 or 87%. And what this means is that the company had to spend 87 cents in order to generate $1 of gross profit. In the long term, it is really important that this ratio is less than 1, because if it is not, it means that the company has to spend more money on operational expenses than it generates in gross profit. If this situation continues, what's the point of operating the company? It doesn't make any sense to spend $1.50 on operational expenses to get back $1 in gross profit. And let me show you an example of a company that has this problem. This is the income statement of Caldive International, which is in the business of helping oil and gas companies with various projects in the Gulf of Mexico. When you add up all of the operational expenses other than fixed assets impairments and gain on sale of assets and provision for doubtful accounts, we get 68.7 million. So let me just show you. I take, in this case, I'm not going to take the total expenses because there's certain expenses here that I want to exclude. So as a result, I take 59,181, and this represents selling and administrative expenses, and that's the only thing that I'm going to take from here. Then I add 9,227 for interest expense, and then I also add 337 for other expense. And notice on this income statement, these numbers are positive. On the other one, they were negative. But in this case, even though they're positive, it is an expense. It's not it's not income. So when I add them up, I get 68.7 million. And when I compare it to gross profit of 14.2 million, obviously this is not enough to spend this much money to get only 14.2 million back. But to calculate the expense to gross profit ratio, I take this number 68.7 million and I divide it by 14,266, and we get a expense to gross profit ratio of 4.82. And this is not a good situation because the company is spending $4.84 to generate $1 in gross profit, and it doesn't take a genius to realize that if it continues like this, the company will eventually go out of business. And because of this predicament that this company is facing, its stock price has been getting killed over the last several years. Look at this chart here. In 2008, the stock was as high as $14, and now it's $1.26. And notice that I'm not saying that this is not a good investment at these levels. It might be a wonderful investment if the company can get the expense to gross profit ratio below 1. And if it did, the stock will probably triple from here. But the question is whether they will be able to get to this level. But the bottom line is that when you look at the expense to gross profit ratio, you want to see it below 1. The marketing expense ratio is not a very well-known ratio, but I think that it's really important. Imagine you're running a business that manufactures and sells video cameras. In order to generate sales, you would have to spend some money on marketing to get some exposure. Wouldn't you want to know what kind of results your marketing dollars are generating for you? Well, of course you would. Well, this is what the marketing expense ratio is all about. The formula for the marketing expense ratio is marketing and expenses divided by total sales. To calculate it, let me use a company called Ambassadors Group as an example. So in front of you, you see the income statement of the Ambassadors Group. As you can see, in 2011, the selling and marketing expenses were 40.4 million. So to calculate the marketing expense ratio, we take this number and we divide it by total revenues. So let's go ahead and do this. We take 40,367 for selling and marketing divided by total sales 66,438, and we get 0.61, which means that the company had to spend 61 cents on marketing to generate $1 in total revenues. If we did the same calculation for 2009 and 2010, we would get the following results. Now you can see a pattern. As you can see, the company's marketing strategy is getting more and more inefficient. In 2009, it had to spend 40 cents to generate $1 in revenue. In 2010, it had to spend 55 cents to do the same. And in 2011, it had to spend 61 cents to get $1 in revenue. So what's going on in here? Well, you can't really answer it by looking at these numbers, because all this is showing you is that there might be a problem. So the next step would be to do some research and find out what the problem is, if there is any. I did this kind of research for Ambassadors Group, and I learned that the company's marketing methods are simply outdated. What this company does is host international trips for students who live in the United States. And to recruit these students for their trips, the company uses direct mail, which used to work better in the past. But now students are spending more and more time on the internet, and incorporating some kind of social media marketing strategy is probably a better way to increase the effectiveness of the company's marketing dollars. Actually, this is exactly what some big shareholders of Ambassadors Group are proposing. The formula for a floor space per employee ratio is simply the total amount of space that the company occupies divided by all the employees. And usually you can find both pieces of information in the 10K. For example, if we search Control F and search for properties, let's see if we can find out how many square feet. You see here under item 2, we can find out how many square feet the company occupies. It's 132,000 square feet here, and sometimes they might give you more information on other offices that they might occupy in different cities. If we want to find out the number of employees that the company has, we just search for employees. Let's go all the way to the beginning of the report and search for employees. And as you can see, we can find out the number of employees. And at the end of 2011, the company employed 240 employees. So these two pieces of information are enough to calculate the floor space per employee ratio. Let me go back to the income statement again. Okay, here it is. Okay, so why does it matter how much space the company uses per employee? Well, think about it. If you are running a business and you're trying to maximize profits, are you going to rent additional space just for the fun of it? Well, no, of course not. You don't want to waste money. You will only rent as much space as you need, obviously without sacrificing quality and productivity. But if you find that a company wastes money on unnecessary space, then you have to ask yourself a question. Well, what else are they wasting money on? Let me give you an example. So to calculate the formula for calculating the floor space per employee is simply the total space the company occupies divided by the number of employees. And on the screen you have the ratios, the floor space per employee ratio that I calculated for years from 2005 and 2011. And as you can see, in 2005 the ratio was 283, And the way I calculated it was in 2005, the company only occupied 66,200 square feet, and it only had 234 employees, which equals 283. Then in 2006, this ratio was again very close, 242, not much different. But look here, look at this jump from 2007 to 2008. In 2007, it was at 266, but in 2008, it was almost 500 square feet per employee. And look at 2010, it was over 600 square feet per employee. Why did it go up like this? Well, is this company growing so fast that it needs all this extra space? Well, let's quickly look at the income statement. And let's look at the income statement of this company from 2007. As you can see, in 2007, total revenues were 114.5 million, and then it decreased to 97 million, and then in 2009 it was 98.6 million. Then let's jump in here. 2010 it decreased to 76.1 million, and then it decreased again to 66.4 million. So obviously revenues went from almost 115 million to 66.4 million. So obviously they're not growing revenues, the company is not growing, so why are they needing so much space? Well, if you dig a little deeper, you learn that before 2007 the company was on fire. I mean, look at 2007. Net income was 31 million, and then look at net income in 2001. It was only 2.9 million. So when the company's business was on fire in 2007, instead of putting the money away and returning it to shareholders, they decided to build a brand new headquarters. What a waste of money! And you know what they're trying to do now? They're trying to sell it for half of what it cost them to build it. What a brilliant capital allocating decisions. Anyway, the point of this illustration is not to bash the management of this company, but to show you that the floor space per employee ratio can be useful to you in seeing how the management is allocating capital. By now you should already know that most businesses extend credit to their customers when selling them products or services. When they report a sale, it shows up on the income statement and also on the balance sheet. On the income statement, revenues increase, and on the balance sheet, accounts receivable increase. At this point, no cash is being exchanged. In other words, the sale happens, but the company does not receive anything from the customer other than an IOU. If the company is slow or unable to collect on this IOU or accounts receivable, then this is a big problem. And to measure the company's ability to collect on its accounts receivables, you can calculate what is called the receivable turnover ratio. And the formula for this is total sales divided by average accounts receivable. And I will show you an example of how to calculate it. This is the income statement of Flow International Corporation. So the two variables for the formula are sales, which we get from the income statement here, and also we need average accounts receivable, which you find on the balance sheet. And what do I mean by average accounts receivable is, you see this number here, 46.8 million. This is what accounts receivable were at the end of this reporting period. 47.1 is what the accounts receivable were at the end of the previous reporting period. But the end of the previous period is the beginning of the next period. So in order to calculate the average, we combine these two and we divide them by 2. So what we would do to find the average accounts receivable, we would take 46,830 plus 47,082, and we would get 93.9 million, 93.9 million, and divided it by 2, and this is 46.9 million, which is the average accounts receivable. So now that we have the average accounts receivable, let me clear this. We can go back to the income statement and we can take out the calculator again, and to calculate the receivable turnover ratio, we take total sales 253,768 divided by the 46,956, which is the average accounts receivable that we previously calculated, and what we get is 5.4. What this number tells you is that Floor International Corporation collected its accounts receivable 5.4 times during the year. And there is really no hard and fast rule as far as what is the best receivable turnover ratio, and it differs from one industry to another. With that being said, in general, a high number means that the company is good at collecting accounts receivable. And if the number is too low, then there might be a problem with collecting receivables, but there's a balance that has to be maintained. And here's what I mean. If the company is too strict when it comes to providing credits to its customers, then the accounts receivable turnover will be high. But this might have a negative impact on sales, because if people are not going to buy from a company that does not extend them credit. And to remedy this problem, maybe the management needs to lower its standards a little bit in order to help sales. But when calculating the receivable turnover ratio, the best thing that you can do is to calculate it for various different years, for 2012 compared to 2011 and 2010, or maybe you calculate it and you compare it from one quarter to another. And you do this because you want to see if the the receivable turnover ratio is different from one reporting period to another. And if in one period the ratio jumps a lot or decreases a lot, then it might make you ask some questions. So this is just the best way that you can use it, and this should help you understand the company and whether there are any problems or not. The amount of inventory that a company has can have significant economic consequences. For example, too much inventory is wasteful because there are costs associated with it, such as storage costs and insurance costs. Also, if inventory is unsold, it might be damaged or become obsolete. On the other hand, if a business has too little inventory, it might lose sales because customers do not have enough choice. Consequently, inventory management is a really big deal. One way to monitor inventory is to calculate what is called the inventory turnover ratio for various years and compare them to each other. The inventory turnover ratio measures the number of times on average the entire inventory is sold during a particular year or a quarter. The formula for inventory turnover ratio is cost of goods sold divided by average inventory. We will use Flow International Corporation as an example again, and you can get the cost of goods sold from the company's income statement. And in this example, the cost of goods sold is equal to 154.4 million. Now, to get the other variable, we have to go to the balance sheet, and we want to look for inventory and calculate the average between the beginning of the period and end of the period, which is a very similar calculation, same calculation pretty much that we did for accounts receivable when we wanted to find average accounts receivable. So let's go ahead and calculate average inventory. So we add these two numbers together and we divide them by 2. So we take 40,069 plus 28,609, and we get 68.7 million divided by 2. The average inventory for 2012 reporting period was 34.3 million. So let me clear this out, and let's go back to the income statement. So again, if we want to calculate the inventory turnover ratio, we start off with the cost of sales or cost of goods sold, which in this case is 154,400 divided by the average inventory that we just calculated, which is 34,339, and we get a result of 4.5. And what this number is telling you is that Flow International Corporation sold its inventory 4.5 times in fiscal 2012. And again, as with many of these ratios, the best way is to calculate the ratios for different periods and calculate them to one another. And a decreasing inventory turnover ratio may mean that the company is having a hard time selling its products, or it is loading up on too much inventory for the market to handle. An increasing inventory turnover ratio, on the other hand, may mean that the products are flying off the shelves, or the company is not stocking enough inventory. So the inventory ratio, when it's increasing or decreasing, it's very hard to tell, exactly why it is happening like this, but it should raise a red flag, and this should make you ask the management to explain to you why is it decreasing or increasing.
Entrepreneurs start businesses because they hope that they will generate profits for themselves. They also understand that profits are very important because without them, businesses cannot survive. Operating in an unprofitable fashion can only last for a limited amount of time because losses deplete capital until nothing is left to pay for wages or buy raw materials to manufacture products. To measure the adequacy of profits, we can calculate what is called profitability ratios. So let's go ahead and take a look.
When you're thinking of starting a company that produces a product, the first thing you look at is whether you can make it for less than you can sell it for. For example, let's say you wanted to be in the business of making bicycles. Well, you would add up all the costs of your raw materials and labor to put the bicycles together. At this point, you wouldn't necessarily include any cost of marketing it or paying for your office space or anything like that. In other words, you would just be interested in gross profit or the gross profit margin, which is calculated by the following formula. Gross profit margin is equal gross profit divided by sales. And in our example of Flow International Corporation, to calculate gross profit margin, we would take 99.3 million, so 99,368 divided by total sales, which in this case are 253,768, and we get 0.39 or 39%. And what this gross profit margin of 39% tells you is that for every $1 in sales, you get to keep 39 cents. But this is not the total bottom line yet, because there are more expenses to running a business than simply the cost of manufacturing a product or service. If you see a pattern of gross profit margin improving from one period to another, it might mean that the company figure out a way to make the product cheaper. Maybe the company outsourced its manufacturing to China, or maybe they bought a piece of equipment that lowered the manufacturing costs, or another reason for increasing gross profit margins could be that the company was able to increase the prices of its products faster than the costs of its manufacturing are increasing. While it is very important for any business to generate positive gross profit, it also has to generate an operating profit. In other words, you still have to have money left over after operational expenses that are not directly associated with manufacturing or delivering a particular product or service. For example, rent for your office space or marketing costs are not included in the marketing costs. They are part of operating expenses, and for operating profit margin ratio, operating expenses need to be included. You use operating profit to calculate operating profit margin. So you take this number instead of this number and you divided it by sales. In other words, the formula for the operating profit margin is operating income divided by sales. In our example of Flow International Corporation, this is how we calculate operating profit margin. We take operating income of 14,669 divided by sales of 253,768, and we get 5.8%. And the operating profit margin of 5.8% tells you that for every dollar in sales, the company gets to keep 5.8 cents after the cost of manufacturing or delivering a service and after all of the operational expenses. If you see the operating profit margin increasing from one period to another, then maybe the company is able to control its expenses better or charge more for its products or services. But here's another thing. Certain businesses benefit from what is called operational leverage, meaning that they can sell more products or services and their expenses might not necessarily go up as fast. Here's an example. This is the income statement of a company called Bridgepoint Education, which is an online school very similar to University of Phoenix. Actually, it is the competitor of University of Phoenix. And on the screen, what you see is I calculated operating profit margins for Bridgepoint Education for 2009 and 2010. And in 2009, the operating profit margin was 18%, and in 2010, it was 30%. This is a significant improvement. And let's figure out why. If you look at the income statement, you see that revenues increased. And the reason for the increase was because the company enrolled more students into their educational programs. In other words, the volume went up. But when you go over to the expense side, you see that instruction costs and services went up. And it is understandable because when you serve more students, you have to spend more money on instructional costs. Also, marketing and promotional expenses went up too. And it is also understandable because in order to enroll more students, well, you first have to get them to enroll somehow. And most likely you have to spend more money on advertising. But look here, general and administrative expenses pretty much stayed the same. Well, actually, they decreased a bit. And the reason for this is because the company benefits from operational leverage. As it enrolls more and more students, general and administrative costs do not go up in the same proportion. Because of this, the operating profit margin increased from 18% in 2009 to 30% in 2010. And the usefulness of calculating the operating profit margin is that if you analyze it enough, then many times you'll be able to figure out whether the company benefits from operational leverage, and if it does, then you can kind of estimate what it can make in the future depending on what kind of estimates you have for revenues. So it can really help you out a lot figuring out what the company could potentially be worth in the future, and then you compare it to what the stock is trading for today. Net profit is the ultimate bottom line. It is good when a business can generate gross profit or operating profit, but at the end of the day, it also has to generate net profit, which is what is left over after paying interest on what is borrowed and taxes to the government. Look here, when we were calculating gross profit margin, we used this number. But this did not include operating expenses such as advertising, research and development, and other administrative costs. To remedy this, we used this number to calculate operating profit margin. But we still have more expenses such as interest here and other expenses here. Then we also have to pay income taxes. Only after we take these expenses into account can we arrive at net profit, which we later can use to calculate net profit margin. So in this example, to calculate net profit margin, we are going to use net income, which is the ultimate bottom line, 9,449, and we divide this by sales, 253,768, and we get 3.7%. So the net profit margin of 3.7% tells you that for every $1 in sales, the company gets to keep 3.7 cents after all of the costs and expenses associated with running the business. To calculate gross, operating, or net profit margins, we only used figures from the income statement. We compared each of the profit figures with total sales in order to arrive at certain percentages. But this doesn't tell you the whole picture, because let's say that a company generates 10 cents for every dollar in sales. Well, that's nice to know, but how much did someone have to invest to create this kind of business? And to measure how much the company is making from the money invested into the business, we can calculate what is called return on equity. And the formula for return on equity is net income divided by shareholders' equity. And to be able to calculate it, we have to use both the income statement and the balance sheet. And in the example of Flow International Corporation, what we will do is we will take out a calculator and we will first find net income, which in this case is 9,449, and we will divide it by shareholders' equity. So we go to the balance sheet, and the shareholders' equity in this example is 91 million. So we take out the calculator and we divided the previously entered net income by 91,048, and what we get is 10.37 or 38%. What this number tells you is that for every $1 invested in the company by shareholders, the company is generating a net profit of 10 cents. Obviously, the levels of return on equity differ from industry to industry, and some companies require a bigger capital investment than others. Consequently, it doesn't make any sense to compare a company in a capital-intensive business to a company that does not require much capital. In general, the bigger the return on equity, the better, because this means that the company is able to generate more with less investment from shareholders. And I hate to use generalizations, but returns on equity of more than, let's say, 10% are considered pretty good. But this doesn't mean that you cannot make money investing in companies with very low returns on equity, because in investing, it is all about the price that you pay for something versus the value that you receive, in return. Another similar metric to return on equity is return on assets. And to calculate it, instead of taking net income and dividing it by shareholders' equity, we take the same income and divide it by total assets. So let's do it in this example. So we take net income of 9,449 and we divide it by not shareholders' equity anymore, but total assets, which in this case are 167 million. So divided by 167,066, and we get 5.7%. And what this number tells you is that this company generated 5.7 cents for every dollar invested in the company's total assets. The bigger the number, the better, because this means that the company is able to earn more on less investment in assets. As with return on equity, return on assets differ from one industry to another. For example, manufacturing companies require a lot more assets than, let's say, service-oriented companies, and therefore returns on equities for manufacturing companies will be less than return on equities for service-oriented companies. One other thing that I want to point out is that when calculating a return on assets, you do not differentiate between the ways that the company paid for these assets. In other words, you treat it as if the company owned all of these assets free and clear without borrowing any money. Because of this, some investors choose to add back interest expense to express that. Here's what I mean. You see, if we go back to the income statement, you see this number here, 1.1 million of interest expense. Well, when we use net income to divide it by assets, well, the income statement, the net income was lower by the interest expense amount. And if we assume that the assets are owned free and clear, we should probably take out the interest expense. And this is exactly what a lot of investors do. So here's what we would do. We would take the net income, 9,449, and we would add back the interest expense. So in this case is 1,112,000. And we have adjusted net income of 10.5 million. And then we go back to total assets, and now we take this number instead of the previous net income and divide it by total assets, 167,066, and now we get a return on assets of 6.3%, which is obviously a little higher than previously calculated return on assets, because our net income is higher because we took out interest expense.
In your personal life, what do you need to have in order to get a loan from a bank, whether it's on a business or a house? Well, you need to show the bank that you can actually pay the loan back. And you can do that by showing the bank how much you're making, or maybe you can show other assets that you own and possibly pledge them as collateral. For publicly traded companies, a very similar process takes place before a company can raise money, whether it is through the sale of common shares or bonds. To help you measure the company's ability to raise capital and pay its obligations, you can calculate various ratios called solvency ratios. So let's take a look at some of them.
The debt-to-equity ratio is probably the most popular ratio used by investors to determine whether the company has too much debt or not. It is calculated by taking total liabilities and dividing them by shareholders' equity. And to find these two variables, all you need to do is use the balance sheet. So in this example, we're looking at the balance sheet of Flow International Corporation. And to calculate debt to equity ratio, we have to scroll down below, and let's take out the calculator. We would take total liabilities, which is 76,018, divided by total shareholders' equity of 91,048, and we get 84%. If this ratio is less than 100%, like it is here, it tells you that a greater percentage of the company's assets are funded by shareholders than by creditors. I personally do not like to invest in companies that have too much debt in relation to equity, because debt is a double-edged sword. When you use other people's money, yes, you can buy more assets, and if the assets are earning more than what it is costing you to service the liability, then the returns on your own money increases. This is called financial leverage. But what happens when the business slows down? Well, it can get a little scary, because you still have to keep making payments on your debt, even though your business is generating less money. And I can't really tell you how much debt is too much. You have to use your own judgment. Companies such as Coca-Cola, which have very predictable business models, can probably take on more debt and still be okay. But companies that operate in cyclical industries should not go crazy with taking on too much debt, because when the tough times come, the large debt levels may force them into bankruptcy, and you as an investor will obviously lose everything. And believe me, it is not a pretty picture. Debt to assets is a ratio similar to the debt to equity ratio, but this time, instead of comparing total liabilities to shareholders' equity, we are comparing it to total assets. So the formula for debt to assets ratio is equal total liabilities divided by total assets. And in our example, to calculate it, we would take total liabilities 76,018 divided by total assets, which in this case is 167,066, and we get 45.5%. What this number tells you is that 45.5% of the company's assets were financed by creditors, and the rest was financed by equity. I personally like this number to be as low as possible, and the maximum that this number can get to is 100%. And the closer it gets to 100%, the more I get worried. Debt only becomes a problem if the company cannot, for whatever reason, pay the interest payment or repay the entire loan. The times interest earned ratio measures the company's ability to pay interest payment from the profits that it generates. The formula for times interest earned ratio is net profit before taxes plus interest and divided by interest expense. In other words, what we are trying to do is look at the profits to see if they are enough to cover interest expense. And here's how we do it. We go to the income statement and we find income before taxes. The reason why you want income before taxes and not after taxes is because you don't pay any taxes until you pay interest on the borrowings. So in our example, income before taxes is 12.6 million, and now this number already includes interest expense of 1.1 million, so we have to add it back. So let's take out the calculator and we will type in 12,665. We add back interest expense 1.2, and what we get is a 13.8 million. And this 13.8 million is the income that can be used to pay the interest expense. So we take this number and divide it by interest expense, which is 1.1 million. 2. And what we get is 12.4. And this means that the company earned 12.4 times more money in profits than it needs to pay in interest expense. And anything above 10 is pretty healthy. But just like it is hard to make generalizations about how much debt is too much in relation to equity or assets, it is also hard to say what is a healthy number for the times interest earned ratio. With that being said, a ratio of 1 is unacceptable, because a ratio of 1 tells you that the company generated just enough profits to pay for the interest expense, and there is no cushion left for something to go wrong. And if a ratio of 1 is unacceptable, a ratio of less than 1 is a disaster, because a ratio of less than 1 tells you that the company generated less in profits than it has to pay, for the interest expense. When you get a loan to buy a house, your monthly payments include both the interest and principal repayment. The same is true for business loans, unless of course the loan is structured in a way that you only pay interest, and after some period of time you pay off the entire amount that you owe. In the previous ratio, which was the times interest earned ratio, we only looked at the interest expense, and we compared it to the profits generated by the company and to see if they are enough to cover the interest expense. And on any income statement like the one that we have here, this amount is only interest. It does not include the principal repayment. But you also need to make sure that the company has enough money to pay down the required amount of principal for a particular period. And to do this, we calculated what is called the cash flow to debt maturities ratio. And debt maturities means a principal repayment that is required for a particular period. The formula is cash flow to debt maturities is equal net profit after taxes plus depreciation divided by debt maturities. And let me show you how to calculate it. And I'm not going to use this company, Flow International Corporation, to demonstrate this, because this company barely has any debt. So, there's not much to repay. Let me use a different company called Mitcham Industries, which is in the business of leasing seismic equipment to oil and gas companies, and this company helps their clients find oil and gas reserves in the ground by providing them with seismic equipment. But on the balance sheet that we have on the screen, we have 12.8 million of long-term debt. And when we go to current liabilities, we have 1.4 million of current maturities. And what this means is that the company has a total debt of 12.8 million plus 1.4 million, which is in total 14.2 million. And out of this amount, 1.4 million is coming due within the next 12 months. And this is not interest, but the principal repayment. And to see if the company generates enough money, we have to calculate the cash flow. And to do that, we go to the income statement and look for net profit after taxes and interest. So let's go to, here's the income statement, which pretty much we look for, the bottom line, net income. And this time we want the number or net income after interest expense, because the interest expense need to be paid first, and then taxes, and then whatever is left can be used to pay down debt. This is why we use this number. So in this example, the net income is 24.3 million. Then what we want to do is add back any depreciation to arrive at the cash flow. And to do this, we have to, well, let me first take out the calculator, and we will take net income, which is 24,321, and we will add depreciation, and to find depreciation we have to go to the cash flow statement, and on the cash flow statement the depreciation and amortization is 28.7 million. So we take the calculator back out and we add 28,774 to net income that we previously entered into the calculator, and what we get is 53 million. So this is our cash flow, and the reason why we add back depreciation is because depreciation is a non-cash expense. So now that we know that we have 53 million of cash flow available, we compare this number to current debt maturities, and to do that we have to go back to the balance sheet and look for current maturities of long-term debt, and we compare the cash flow that we calculated to this number. So what we do is we take this number 53 million and we divide it by current maturities, which in this case are 1.4 million, 1,399, and what we get is 38. So as you can see, this company has plenty of money to take care of the principal repayments on its debt, and the higher the number the better, because it means that the company generates more than enough money to pay down its debt. The rest can after repaying the debt, the rest can be used to pay dividends, acquire other companies, or to grow internally. However, when this number gets close to 1 or even below 1, this is not good news, because this tells you when the ratio is at 1, this tells you that the company generates just enough money to just enough cash flow to pay down its debt. But again, there's no cushion to account for something that can go wrong. But if the ratio is less than 1, then it means that the company generates cash flow that is not sufficient enough to satisfy the current maturities of long-term debt, and this is a problem because the company can be in default, and as a shareholder this is not good news for you.
In this video we covered various different ratios that can help you determine the company's strengths and weaknesses. And don't think that we covered them all, because you can literally calculate thousands and thousands of different ratios if you wanted to, because there are a lot of different variables that you can take from one financial statement and compare it to variables either on the same financial statement or another financial statement. Probably the most important thing that I want you to take away from this video is that one particular ratio alone doesn't tell you much. In order to get the most out of it, you have to compare it to ratios from other years or other quarters for the same company, or you can compare the same ratios to a company of a competitor in the same industry. Then and only then you can start seeing certain patterns that can lead you in certain directions. And they might not necessarily give you answers to your questions, but they might help you come up with questions that you can later ask the management to get a better idea of what is really going on. For example, assuming that the accounts receivable turnover ratio deteriorating is bad may not be correct. You first have to find out why it is deteriorating, and then you can decide whether it is good or bad. So with that being said, thanks for watching, and I hope that the video was educational.